because we have to think carefully what the financial industry is. The financial industry is an intermediate good. It's not an end product. It's not like they're making food for us or building houses. It's an intermediate good. The analogy I make is the trucking. Okay, we need a trucking industry. It's very, very important. It's about bringing goods from point A to point B. Now, the financial industry has exploded relative to the size of the economy over the last 3 decades. It's quintupled. It's 5 times as large as it was back in the 70s relative to the size of the economy. The question is, what have we gotten for that? Are we more secure in our savings? Do we think capital has been better allocated? I mean, maybe that's true, but at least on the face of it, it's hard to argue that that's the case. Now, suppose we get our financial transactions tax and we see a big decline in the volume of trading. To my mind, that's a benefit. What that means is the financial sector is becoming more efficient. Why would we want more people employed in trucking if they're not better able to get goods from point A to point B? So if we reduce the volume of trading without in some way impeding the financial sector in doing its proper function, securing our savings, allocating capital, that's a pure gain for the economy. So I would argue here that both we stand to raise an enormous amount of revenue. The bills before Congress could talk about raising in the order of $100 billion a year, a very substantial amount of revenue, and changing the way Wall Street works. And to my mind, that's at least as important. We need a financial sector that's about securing our savings, allocating capital, productive investment, not about churning as an end in itself. So in that case, I would say it's a win-win story.